Coming up on today's show, stocks finish lower, why markets are off to a soft start for the year, are we still likely to have an up year after a failed Santa Claus rally, the global economy set to deliver its worst growth in 30 years, will Nvidia lead the market again, along with Bitcoin, and technical analysis of all the most important charts. And a warm welcome back to the Click Capital Daily Market Show, everybody. We're here kicking off 2024. I hope you had a relaxing holiday season and we're all fired up and ready to go for this year. However, the stock market hasn't been so excited. Actually off to a bit of a soft start, bit of a pullback in the indices. However, like we can see today, we've still got mega cap tech, especially Nvidia, breaking out and holding up a lot better than the rest of the market, and that was the big theme from last year. So we're going to take a look and see what are the chances of that continuing this year and what some historical patterns and indicators are showing us today. And just looking at the S&P 500, we're coming back up to those all-time highs, just finishing the day slightly lower at 47.56. All other indices are lower, including the Russell 2000, which has had a bit of a pullback to start the year off. And we actually got a failed Santa Claus rally the last 5 trading days of the year, and the first 2 days of this year, that period closed negative. And I'll show you a bit soon what historically that has resulted in. However, there's a composite index of the Magnificent 7 mega cap tech stocks actually breaking out to new all-time highs today. And that was thanks to none other than Nvidia, having a really great start to the year so far, climbing from 492 up to 531 today. And stick with me, I'll show you a bit later on why investors are getting excited with Nvidia again and what are the chances that it could keep going. First, let me just take you through some news, research and data from today. Then we'll hop back on over into the charts and see what else we can find out there. So there was a lot of bullish enthusiasm and optimism and positioning coming into this year. However, we've seen a bit of a pullback with the S&P 500 putting in its first weekly loss in 10 weeks, and bonds also falling back as we got a little bit of a bump up in rates. And according to Bloomberg, the sell-off in stocks and bonds to start 2024 marked the worst start to the year for broader markets since at least 2003. We also got a better than expected jobs report on Friday, showed 216,000 new jobs. That pulled back odds a little bit that we're going to get a rate cut in March. However, the overall trend in the jobs market is still softening a little bit. The Fed's forecasting 3 rate cuts in 2024, while Fed Fund futures are pricing in more like 6. So many people are saying this is just a healthy pullback, a bit of a backfill in the market. Soft landing still looks likely, and don't forget this is a presidential election year, and historically speaking, about 80% of the time S&P 500 finishes up on the presidential election years. So we didn't get the Santa Claus rally, which has taken away the prospect of a January trifecta, and that's when we get the Santa Claus rally, the first 5 days of January rally, and January itself rallying. When those 3 things happen, the odds for the year finishing higher are really good. A lot of price action to start the year off kind of plays into the mood for the rest of the year, and generally when we see weakness around that time, that also bodes bad for the year too. So the last time the Santa Claus rally failed was actually in 2022, and that didn't bode well for the markets. S&P 500 finished down about 20%. Nasdaq finished down about 33% for the year. They didn't end up bottoming till middle of October on that big bullish engulfing we got. So on the previous 6 occasions, we didn't get the Santa Claus rally. 4 of those years finished lower. Notably 2008 down 38.5%, with the biggest year coming in at 9.5%. And so the performance of January as a whole will influence that as well. However, contrasting those seasonality patterns is the election year pattern. And so typically a president, especially an incumbent who wants to stay in, they can do everything in their power and spending to shore up as many votes as possible. And that can be a bit of a tailwind for the economy when you get increased government spending. And so just looking at a seasonal historical chart here of election years since 1950, the average gain has been 7.3%. However, for the previous year, we were up more than 10% like we were last year in the S&P, then the average gain has been 10.5%. And just looking at the month-to-month performance, we get a little bit of a rise into mid-February, then we kind of taper off a bit into mid-March where we bottom, then we pretty much rally up into that seasonal period, late September, October, where we get a bit of weakness like we saw last year and 2022, then we get the holiday season rally. So it'll be interesting to see if markets follow this seasonality this year because they followed it almost to a T last year. However, we've already got some conflicting signals by not getting that Santa Claus rally in first 5 days. We'll just be looking to see how January finishes and stick with Click Capital because we'll follow this chart all year long and see how closely we track against it. So it's very likely we see a record high in the S&P 500 in the coming days or weeks. We're only about 60 points away from it, and looking back in history, according to Ned Davis research, the years in which the stock market does hit a record high coincide with a median gain of about 15%. And so with all these strong historical patterns, election year, we've got momentum in the market, the consensus is we're getting a soft landing. It's no surprise that a lot of people are getting excited. There's a lot of bullish sentiment, and we're seeing headlines like this: stocks will trounce bonds for years to come, and a recession seems almost impossible right now. However, looking back in history, these are the type of things you hear just before we get a recession or at a market top. And this is a former Fed trader who's saying epic amounts of deficit spending will support stocks going forward. And it's true, a lot of Fed government spending does materially cause the economy and stock market to go up. But how long can this helicopter money keep artificially inflating assets for? Because it could be a situation, like research from JP Morgan says, that the huge $34 trillion in outstanding national US debt is like the boiling frog situation. If you throw a frog into boiling water, it jump right out. However, you put it in cold water and slowly boil it, it'll often stay in there. And that could be a good analogy for how markets and just the public perception of US national debt may be treated. And then when a lot of people come to the realization that it truly is unsustainable, we could get a big repricing in markets, a spike in rates. And so this is an ever-present risk in markets, whether it plays out this year or next year. It's something that's not going away anytime soon. And we've still got geopolitical risks out there, things boiling over in the Middle East or with Russia and China. But for now, investors are not paying too much attention to that, become quite complacent. Stocks have stayed overbought levels for a few months now, and we're starting to see a peak in the amount of media articles mentioning the phrase soft landing. And previously, when we've seen that peak was right before the global financial crisis, right before the tech bubble burst. We got 2 recessions in that time. We did see a little peak in the mid-90s. We didn't get a recession back then. However, we did when we saw a little peak in the late 80s going into the early 90s. But the only other time we've seen more mentions of soft landing in articles was back in 2000. So if we do get the soft landing, no recession this year, then the consensus and the crowd has got it right. But the Fed said they're going to cut rates this year. The market thinks they're going to cut rates more than double what the Fed says. And looking back in history, 150 basis points of cuts, which the market expects this year, is almost always due to a recession. And so that'll be the next big thing for markets. Currently pricing in almost 2/3 chance that the Fed's going to cut in March, just a little over 2 months away. And they're pricing in they're pretty much going to cut every meeting for the rest of the year. And so one of two things is going to have to happen in the economy for this to happen. Inflation's going to have to absolutely nosedive below 2% for the Fed to be justified cutting that much. Or we get a recession or nasty surprise that causes the Fed to want to cut rates aggressively to try and put a floor in the economy. And so this year, are we going to see the rest of the world catch up with the States, or the States catch up with the rest of the world who's been a bit soft economic growth this last year or two? Well, according to World Bank, the global economy is set to record its worst half-decade growth in 30 years, with them citing geopolitical tensions and conflict in the Middle East adding to downside risks, and saying that most advanced and developing economies will grow more slowly this year and next than they did in the decade before COVID-19, with global GDP slowing for a third year in a row to 2.4% before increasing to 2.7% next year, 2025. That's far below the 3.1% average the world economy recorded in the decade ending 2020. And a big part of that has been China slowing down this last couple of years, slowdown in global trade, borrowing costs, especially for developing economies, remaining high. Still got some high inflation rates around the world. Definitely seen an uptick in geopolitical tensions the last couple of years. So there's plenty of reasons we could see a pullback. However, we did see the same thing to start off last year, and the stock market didn't care. And that's why first and foremost we follow the price action to kind of see where markets are going. The largest asset manager in the world, Blackrock, cutting 3% of its staff, citing a rapidly changing environment. So apparently they're pulling back on their ESG division, which has been pretty controversial, as they've been criticized of penalizing companies that don't adopt woke practices. And we've even seen things like Tesla having a much lower ESG score than many oil and gas companies and other things like that. However, they could be stepping up investments in AI and machine learning overtake a lot of these roles, and that could be a theme we see continue this year, which would actually be a positive for earnings per share. Moving on to bonds, we got the former bond king Bill Gross saying 10-year treasuries are overvalued after he scored big on last year's rally. He suggested treasury inflation protected securities if you needed to buy bonds. He also did really well last year buying some regional banks and mortgage REITs. However, he's backing away from that recommendation now. And just looking at the 10-year treasury yield, now got it back above 4%. After we sold off pretty hard going into late last year, getting down below 380 just after Christmas there, and we've just done a bit of a bounce now. I'd say the markets are going to be hanging hanging around, waiting to get a bit more of a read from the Fed when they meet for the first time this year on the 31st this month, with it pretty much a foregone conclusion they're going to hold rates steady. And the big one will be CPI inflation data that we get this Thursday. Markets will be really keen off that to see if inflation is going to keep coming down. The Fed will cut rates in March. Moving on to the hottest stock at the moment, that's Nvidia, breaking out to a new all-time high again today. That's been rallying up off some good news in the last couple of days that they're gearing up to mass produce a range of AI chips that are designed specifically for China to meet the US export controls. Basically, less powerful AI chips that the US government's allowing them to sell into China. And so China's an important market for them, and the markets really like this news as they had to delay originally scheduled launch late last year to meet government requirements. However, that looks like it's about to go through soon, and that's why it's climbed to a record high, and a lot of people saying it hasn't peaked yet. We also got the Consumer Electronics Show in Vegas the next couple of days. AI is going to be a big theme of that, and Nvidia is kind of at the heart of this whole AI trade, being the biggest hardware supplier. And so if you remember late last year, I reported to you Nancy Pelosi and her husband loaded up on Nvidia calls and reported it just before Christmas to try and bury it in media headlines, as it's currently controversial with Congress people trading stocks, and it's kind of convenient today to see some positive headlines on US government permitting Nvidia to sell some modified chips into China, most likely more positive regulatory action to come. And it was another really well-timed trade by Nancy Pelosi and her husband. And I guess you don't become worth $200 million by being a lifelong politician based on bad information. She has a history of significantly outperforming, and those call options her and her husband got expire in December this year. So they're betting Nvidia is going to have another great year. And a lot of people are wondering, is it too late to buy Nvidia stock? Well, that's a very hard question to answer. As always, there's always two sides to the coin, depending on how you look at valuation. Trading at 26 times sales seems very, very expensive, and 63 times trailing earnings. However, if they can keep up their current growth rates from last year for the next couple of years, it's possible that valuation could be justified. However, that's some real lofty growth rates that they've got to achieve. And just looking at Wall Street average price target, they've got it at 659, which is about 24% higher than where we are now. And generally, the gap between stock price and price target will close either like it did in 2022 by analysts dropping their price targets, or by the stock price catching up. So the street is even more bullish than the market on Nvidia right here. They think we're going to get up to $650 a share this year. And quantitatively speaking, on the five major factors, it's all but valuation that score really well. Growth, profitability, momentum, earnings revisions, all look good on the computer except for the valuation. And just looking on the daily chart, here we are today getting up to 543 on huge volume. All-time high breakout, market cap now at 1.3 trillion. And on the weekly chart, that is a pretty bullish pattern. After we consolidated for the last 6 months of 2023, kind of put that resistance zone up around 500, and we've just clean broke out to start the year. So it's not something I would short here with all this bullish momentum, and who knows, it may go to 650 this year. However, at 26 times sales, it's kind of hard for me to justify it being good value. But if this does hold up, then that's going to help the Nasdaq and S&P 500 a lot this year. Because just staying on the weekly chart, we've got the biggest stock in the market, Apple, actually pulling back quite sharply from its all-time highs. But we've got the second biggest stock in the market, Microsoft, actually forming a bit of a bull flag on the weekly chart here. That could be primed to break out as well. But in another sign of softening global economic growth, we've got the second largest oil producer in the world, the Saudis, in a rare move, slashing the price of the crude they sell after they spent most of last year cutting production and trying to motivate their partners in OPEC to do the same to try and pump the price up. Looks like they're thrown in the towel a little bit, and traders are jumping on that by shorting oil. And that's Saudi Aramco, the most profitable company in the world. Saudi state-run oil giant cut the February official selling price of its Arab Light crude on Sunday to its cheapest level in over 2 years for its Asian customers. And that's probably a sign that the Saudis see lower crude demand. They're trying to get out in front of it. And so they obviously don't think global economic growth is going to be good this year. And we can see in the price, crude oil futures just trading pretty flat here, looking to consolidate above $70 a barrel. And we may indeed get a breakthrough that support zone of 67.50 in the coming weeks if we keep seeing soft global economic growth. We've also got copper breaking down below the 50-day VWAP after finishing lower last year, another global growth commodity. And just like Nvidia, which did really well last year, Bitcoin, one of the best performing assets. Crypto animal spirits are back, and it too is off to a good start for the new year. And the biggest one, the market's on the edge of its seat, waiting for regulatory approval of the first spot Bitcoin ETF. It could be coming any day or week now, and that would be a huge about face for the SEC with Gary Gensler trying to fight it for a few years now, and it looks like the industry may win out over him after all. So it pretty much looks like a done deal. We've already got the biggest asset managers in the world, Blackrock, Fidelity, lined up, ready to open the doors for investment into Bitcoin ETFs. A lot of other players in the industry as well, like Grayscale, ARK, Wisdom Tree, Invesco, Franklin, and a bunch of others already coming up with their Bitcoin tickers, listing their fees, and it looks like this is all ready and set to go through. And just looking at the daily chart of Bitcoin here, just this morning we got up to almost 48,000. And just taking it out to a clean weekly chart, it was really around this time last year the market really started getting excited that the likelihood of an ETF was going to go through. And so we've rallied about 90% since then. And it just reminds me a little bit of 2017 with speculation of the first Bitcoin futures being launched on CME, which they did in the middle of December. And that was a huge buy the rumor, sell the news, because then Bitcoin collapsed more than 50% over the next couple of months. So I'm wondering whether we get the same deal with the ETF and Bitcoin's going to fall over after it actually comes onto the market, or will there be a huge amount of actual buying? Because as institutional money and new investors rush into those ETFs, they have to come into the Bitcoin market and actually buy a bunch of Bitcoin, and the market's done a pretty good job of front running that money. So we may get one last push and spike. Then we'll see how we go after that first week of ETF trading. That could be maybe a top, and that could be above 50,000, that psychological level. So we're keeping an eye on that one. Just looking at economic data we got out today, not much of too much significance there. Nor tomorrow, it'll be Thursday, the big one. Headline inflation rate year over year expected to come in at 3.2%. Previous reading we got last month was 3.1%. Still got core inflation pretty elevated there, expected to come in at 3.8%. That'll be the biggest piece of news this week. But for now, the market remains quite comfortable. Fear and greed index at 73. Been in the greed zone for about 2 months now. And I'll come back to the S&P 500 at the end of this video like I normally do. Just looking at breadth, we've had a bit of a pullback in the short term. However, looking at my sector trends table indicator, we've still got most sectors green above their 5-day moving average. It's really just materials, oil, gas and energy, clean energy, gold miners that are the most weakest sectors across the board. Still got home builders, semiconductors, healthcare, staples, SPNQs. Green across the board, all above their moving averages. A little bit softer in new highs and new lows. And you got 138 stocks breaking out to 52-week highs. Again, 76 breaking down to new 52-week lows, including China. Volatility market's super chill. VIX at 12.77 and volatility risk premium only 1.94. Option dealers not forecasting too much volatility in the near future. Still got stocks and bonds correlated, with TLT having a bit of a pullback as well. But high yield bonds still holding up really well. Did a lot better than treasuries last year. And we kind of got the dollar holding ground there just above 102. A little bit of a pullback in shipping rates. We saw that big pop up after the militants attacked commercial ships going through the Red Sea. Commodities as a whole still in a short-term downtrend. And gold forever flirting with those all-time highs, around $2,000 an ounce. Nice pop up, and one of my favorite assets for this year, uranium, getting close back to multi-year highs. Bit of sideways action in international stock markets except for China, coming back down to its multi-year lows, and this is another contrarian bet of mine. Stay to the end of this video and I'll show you my 10 ETF picks for this year, and I updated the portfolio tracking spreadsheet, which you can get a free copy of as well. There's a Nikkei actually breaking out, and the Aussie 200 had a good last month, just doing a soft pullback here. So a big pullback in the last week of growth versus defensive sectors. And we've still got the Nasdaq in a bit of a downtrend versus the Russell 2000. Inflation expectations still on a downtrend. Saw the cannabis ETF pop up pretty good there on Friday. Another one of my contrarian picks for this year. And cybersecurity stocks really close to highs as well. Another one in my ETF portfolio. Losing sector today was clean energy, really volatile still, followed by gold miners and regional banks. There's a look at the Magnificent 7, with Tesla finishing a bit weaker today. We're looking for it to find support around this 230 zone. And there's JP Morgan, which has been on absolute parabolic tear since October. It's looking a bit toppy here. Some of my indicators saying we're due for a bit of a pullback and correction. Meme stocks really weak today. There's one of my contrarian picks, Alibaba, looking to potentially be put in a double bottom here. See some bullish divergences on my indicator, and institutional buying is gone green as well. I think that's good medium-term value there at $72 a share. We'll see whether Intel can hold up this year. Had a really good 2023, one of the best performing S&P 500 stocks. We saw Walgreens dip on Thursday on earnings, but they actually reported pretty good, 66 cents a share, which if you think about it, annualizes $2.60. For a $25 stock, I still think that's good value. Value could make a comeback this year after value stocks have been smashed these last couple of years. And there's actually a chart of the value factor. That's the difference between cheap stocks and expensive stocks. looking back 200 years, had its worst performance this last 2 years, the biggest drawdown. And looking back in history, things that have huge drawdowns, the recovery can be symmetrical as well. We can have a huge recovery. That's just mega cap growth absolutely outperforming traditional old economy value stocks. And it's the big dynamic in the market. You've got stocks like Nvidia trading at 26 times sales. Then you've got stocks like Walgreens, General Motors, Verizon trading at 10 times earnings. Just a huge disparity between the two groups. And so if you watched the last video on my channel, the 2023 wrap up I did on the last trading day of the year, I gave 10 ETF picks as a bit of fun that I'm going to do at the end of every year for the next year. And it's just a simple portfolio, equal weighted 10 different ETFs. I gave my reasons for each ETF. Then we're going to see how it performs at the end of this year. And you can get a copy of this spreadsheet. The link is below this video, or just go to clickcapital.io/tracker. Then you'll come to this page here. All you do is climb up to File, click on Make a Copy, and that'll make a copy into your Google account that you can edit and no one else can see. I've just updated it to add a benchmark. And so the benchmark for my portfolio is the iShares Core Growth Allocation ETF under ticker AOR. And basically that's just a global 60-40, 60% stocks, 40% bonds. And so you can use whatever benchmark you want. Just put in whatever ticker you want there, the starting price for the year, and then it'll automatically update every 20 minutes with the current price and gain. Same with the spreadsheet. All you got to do is enter in your tickers, the quantity purchased, the entry price, and it'll automatically update everything else every day. Also added in a position size calculator. You can enter your account value, target size, what ticker, and then it'll tell you how many shares or units to buy. And these are just some starting stats I manually entered in. The portfolio has a dividend yield of 2.51%. 55% of the portfolio is exposed to US stocks, and I've got some pretty big leans and tilts to small caps and commodities this year. And IPC, that's what I call into portfolio correlation. So there's a cool website called portfoliovisualizer.com. It's free. And under their tools section, they've got asset correlations. And so just using monthly returns over the last 3 years, just looking at the correlations of all ETFs in my portfolio, I summarized all the correlations with the average being 51%. So that's what I'm calling IPC. And basically the lower that is, the more diversified your portfolio is, and you basically just want uncorrelated bets. That's going to, in theory, lower your volatility, increase your consistency. And so I'll just be looking to see if my 10 picks this year can outperform my benchmark. And if you want to have a bit of fun, you can do the same thing. Just pick 10 stocks or 10 ETFs, and you can use this simple Google Sheet tracker that I created to see how it performs. Okay, back to the S&P 500. Here we are consolidating at this all-time high resistance zone. Typically when markets come up to highs, especially all-time highs, they can kind of stall out, maybe pull back a little bit before we either pop out again or go into a deeper correction. And with big stocks like Nvidia breaking out to all-time highs, do have Apple pulling back a bit, looks to have maybe found some support there. And Microsoft is shaping out for another breakup as well. Not to mention we've got super low VIX and those pullbacks in rates. So it's pretty likely that we break out to all-time highs in the coming days, if not next week in the S&P 500. And like I said, we'll be watching to see how January ends for that seasonality pattern. It is an election year. Corporate profits are expected to grow north of 10%. Other than that, we'll just be keeping an eye on inflation, CPI on Thursday, and how the market reacts to that. And as always, we'll follow the technicals first and the fundamentals second. That's all I got for you today on this first show of the year. Thanks very much for coming back to Click Capital. I'm going to do my best for all you guys this year. Hope we can all have a great year, and I'll see you all again tomorrow night. Cheers.